In times when the economy slows down, growth becomes harder to find, interest rates stay high, and uncertainty dominates the stock market, smart investors shift their focus from chasing fast profits to building stable income. History shows that during slow economic cycles, dividend-paying companies often outperform because they provide something growth stocks cannot: reliable cash flow. While prices may move sideways, dividends continue to arrive quarter after quarter, offering both income and emotional stability. Today, we are exploring the top 7 types of dividend stocks that are built not just to survive a slow economy, but to quietly outperform it. The first pillar of a strong dividend portfolio in a weak economy is consumer staples. These are the companies that sell everyday necessities such as food, beverages, cleaning products, and personal care items. No matter how tight money becomes, people still buy toothpaste, soap, snacks, and drinks. This makes businesses like Procter & Gamble, Coca-Cola, and PepsiCo extremely resilient. Their global brands, massive distribution networks, and loyal customer bases generate consistent revenue even when consumer spending slows. Because of this steady cash flow, these companies have been able to increase their dividends for decades, turning them into reliable income machines during economic downturns. The second powerful sector for dividend investors is healthcare. In a slow economy, people may delay buying new cars or vacations, but they cannot postpone medical treatment. An aging U.S. population ensures long-term demand for pharmaceuticals, medical devices, and healthcare services. Companies like Johnson & Johnson, AbbVie, and major healthcare insurers continue to generate strong profits regardless of the business cycle. Their stable earnings and strong balance sheets allow them to maintain and grow dividends, making healthcare stocks a defensive cornerstone in uncertain times. The third category is utilities. Electricity, water, and natural gas are essential services that households and businesses must pay for regardless of economic conditions. Utility companies operate under regulated frameworks that provide predictable revenue and stable cash flows. While these stocks may not offer rapid growth, their dependable income and above-average dividend yields make them extremely attractive when markets become volatile. In a slow economy, investors often rotate into utilities for safety, income, and reduced risk. Fourth on the list are telecommunications companies. In today's digital world, internet access and mobile connectivity are no longer luxuries, they are necessities. Major telecom providers generate recurring monthly revenue from millions of subscribers. This subscription-based model creates strong and predictable cash flow, much of which is returned to shareholders through dividends. Even during recessions, people continue paying their phone and internet bills, giving telecom stocks defensive strength and consistent income potential. The fifth group includes large, financially disciplined energy companies. While oil and gas prices can fluctuate, the biggest U.S. energy firms have diversified operations, strong balance sheets, and a long history of rewarding shareholders. Companies like ExxonMobil and Chevron have survived multiple recessions, oil crashes, and geopolitical shocks while continuing to pay and even raise dividends. In slow economic periods, their scale, efficiency, and global demand help stabilize earnings and support long-term dividend reliability. Sixth are real estate investment trusts, especially those focused on essential property types. REITs that own healthcare facilities, data centers, warehouses, and necessity-based retail generate rental income that remains resilient even when economic growth weakens. By law, these companies must distribute most of their profits as dividends, making them some of the highest income producers in the market. When chosen carefully, defensive REITs can offer both strong yield and protection against inflation. The seventh and final category is conservative financial institutions. Well-capitalized U.S. banks and insurance companies earn steady income from interest, lending, and premiums. While speculative financial stocks may struggle in slowdowns, established firms with strong risk management and diversified revenue streams can continue paying reliable dividends. Their ability to generate consistent profits and return capital to shareholders makes them valuable long-term income holdings. The real secret to outperforming in a slow economy is not chasing hype, but building a portfolio based on stability, essential services, and dependable cash flow. Dividend stocks provide real returns that do not rely solely on rising share prices. They reward patience, reduce volatility, and allow investors to compound wealth over time through reinvestment. When the economy slows, fear often dominates the market, but experienced investors know that this is when quality income assets quietly build wealth. A diversified basket of strong dividend payers can protect capital, generate consistent income, and position investors for long-term success when growth eventually returns. In uncertain times, dividends are not just payments, they are proof of business strength. They represent real profits, real cash, and real value being returned to shareholders. And in a slow economy, that reliability can be the difference between simply surviving the market and truly outperforming it.